What if you could turn $500 a month into something that quietly grows without you needing to watch the market every day? Right now, a lot of people are asking, is it too late to start investing? Or is this the worst time to jump in? But the more useful question is, what happens if I start boring style investing today and just keep going? In this video, we'll follow two people who start with the same income, the same amount to invest, and the same doubts, but they choose very different paths. We'll walk through what they do, how their money grows, and what that means for you if you're thinking about starting now. Meet Alex and Jordan. They're both in their late 20s, living in a mid-sized city, working full-time jobs that pay about $70,000 a year after tax. They each have around $5,000 in savings, no serious debt apart from a small credit card balance they pay off every month, and no investments yet. Their shared goal is simple: build long-term wealth so they can eventually buy a home and have more freedom in their 40s and 50s. Neither is rich, neither is broke. They're exactly the kind of normal earners most people watching this channel can relate to. Each of them decides they can realistically set aside about $500 a month to invest. The big question is, what do they do with that $500 and how soon do they start? That choice will quietly shape their financial future more than any single perfect market moment. Alex and Jordan both have the same $500 a month to invest, but they face the same common intuition trap. Should I wait until the market feels safer or start now while things feel uncertain? Alex decides to start investing immediately. They choose a simple, diversified portfolio, mostly low-cost index funds that track global stocks, and a small slice of bonds. The idea is to stay boring, stay consistent, and ignore the daily noise. Jordan, on the other hand, decides to wait. They think the market looks expensive, the news feels scary, and they want to time it better. So they park the $500 a month in a regular savings account, planning to jump into investments once things settle down. Both choices feel reasonable in the moment, but over time, one path quietly builds wealth through compounding, while the other lets time slip away. The key difference isn't luck or genius, it's when they start and how consistently they invest. We'll look at Alex and Jordan over 3 time blocks: the first 5 years, the next 10 years, and then the final stretch to 25 years. We'll keep the numbers simple and rounded and assume long-term stock market returns around 7% a year on average, with some ups and downs along the way. Remember, past returns don't guarantee future results, and actual numbers will vary by country and time period. In the first 5 years, Alex invests $500 every month right from the start. That's about $6,000 a year going into a diversified global portfolio, mostly stocks with a small slice of bonds. Over 5 years, Alex puts in roughly $30,000 in total. Even with some market dips and rallies, the portfolio grows at around 7% a year on average. By the end of year 5, Alex's portfolio is worth roughly $35,000 to $40,000, depending on how the market behaved. That extra few thousand isn't magic, it's just time plus compounding doing its quiet work. Meanwhile, Jordan waits. They still set aside $500 a month, but they keep it in a regular savings account that earns close to 0 to 2% interest. Over 5 years, Jordan also saves about $30,000, but there's almost no growth. At the end of year 5, Jordan's portfolio is still around $30,000, give or take a little interest. The gap isn't huge yet, but it's real. Alex has started building a machine that can grow over decades. Jordan has only built a pile of cash that sits still. From year 6 onward, both Alex and Jordan finally start investing the same $500 a month. The only difference now is that Alex has a head start of about 5 years and a few $1,000s more in the market. Over the next 10 years, Alex keeps adding $6,000 a year to their existing portfolio. So they're not just earning returns on new money, they're also earning returns on the gains from earlier years. By year 15, Alex has put in roughly $90,000 in total contributions, but the portfolio is worth closer to $130,000 to $150,000, assuming that 7% average return.
Jordan, starting later, has only been investing for 10 years. They've also contributed about $60,000 in total over that decade. With the same 7% average return, Jordan's portfolio is worth roughly $80,000 to $90,000 by year 15. Now, the gap is more visible. Alex's earlier start and extra 5 years of compounding have quietly pulled them ahead, even though both were now doing the same thing each month. The difference isn't from picking hot stocks or timing the market perfectly, it's from starting earlier and staying consistent. From year 16 to year 25, both Alex and Jordan keep investing $500 a month without changing their strategy. By this point, their portfolios are larger, so each year's returns are worth more in dollar terms, even if the percentage is the same. Over these final 10 years, Alex adds another $60,000 in contributions. Their total invested capital reaches about $150,000. With compounding at roughly 7% a year on average, Alex's portfolio could be worth around $220,000 to $250,000 by year 25. Jordan, who started later, adds the same $60,000 over these 10 years. Their total contributions reach about $120,000. With the same 7% average return, Jordan's portfolio might be worth roughly $160,000 to $180,000. The gap has grown, not because Alex is smarter or luckier, but because their money spent more time in the market. Each year that Alex's money was working, earning returns that then earned their own returns, added a little more to the total. Jordan's money did the same thing, but it had 5 fewer years to do it. Imagine both portfolios as 2 plants in a garden. Alex planted her seed 5 years earlier and watered it every month. Jordan planted the same kind of seed later, but watered it just as often. By year 25, Alex's plant is noticeably taller and stronger, not because it's a different plant, but because it had more time to grow. The same idea applies to boring, diversified investing. Start early, even if the market feels uncertain. Invest consistently, even if the amounts seem small. Let compounding do the heavy lifting over decades, not days. Alex and Jordan end up with real wealth by year 25, but Alex's earlier start and extra 5 years of compounding give them a quiet but meaningful advantage. The key takeaway isn't that Jordan failed, they still built something valuable, but that waiting cost them time they can never get back. By year 25, Alex and Jordan both have real wealth, but the numbers tell a quiet story. Alex has invested about $150,000 in total and ended up with roughly $220,000 to $250,000, assuming a long-term average return around 7% a year. Jordan has invested about $120,000 and ended up with roughly $160,000 to $180,000 under the same assumptions. That means Alex's earlier start and extra 5 years of compounding have given them an advantage of roughly $60,000 to $90,000, even though both were investing the same $500 a month once they started. The difference isn't from picking the right stocks or timing the market perfectly, it's from letting their money work for more years. Visually, you can think of their portfolios as 2 growing curves on a chart. Alex starts earlier and rises steadily, while Jordan's line starts later but follows the same upward slope. Over time, the gap between the 2 lines widens, not because one is steeper, but because one has more time to climb. The main drivers of the difference are time in the market. Alex's money spent 5 more years compounding. Consistency, both kept investing the same amount each month once they started. Boring strategy, neither tried to chase trends or time the market. They just stayed the course. This isn't about getting rich overnight. It's about how small, consistent choices today can quietly reshape your financial future over decades. The story of Alex and Jordan isn't about genius investing. It's about simple, repeatable habits. The earlier you start, the more time compounding has to work, even if your monthly amount feels small. Here's a simple checklist you can use for your own boring wealth plan. Decide on a realistic monthly amount you can invest consistently, like $200, $500, or $1,000. Choose a diversified, low-cost portfolio, such as global index funds and a small bond slice. Start now, even if the market feels uncertain, and keep investing the same amount each month. Revisit your plan once a year to adjust for life changes, but avoid trying to time the market. The rule of thumb is this: time plus consistency beats waiting for the perfect moment. If you start boring style today and keep going, you're already ahead of most people who wait. If you want more boring wealth scenarios that quietly change your net worth without hype, without promises of overnight riches, subscribe to Boring Wealth. Each video walks through a simple, realistic situation like this one, so you can see how small, consistent choices add up over time. If you found this breakdown useful, consider sharing it with someone who's been putting off investing until the market feels safer. This video is for general education only and does not constitute personalized financial, tax, or investment advice. Your situation is unique, and past performance does not guarantee future results. Always consider your own goals, risk tolerance, and circumstances, and consult a qualified professional before making any financial decisions.